We're going to look at the structural mechanics of a 58-year-old business that is suddenly experiencing absolute hypergrowth. We're going to examine their business model, the raw financials, the very real risks they're facing, and ultimately figure out if this IPO is a ticket you should be buying. And we've got to start right here with an explosive number: a 78% revenue compound annual growth rate over the last 3 years. I mean, that is a massive trajectory that absolutely demands a serious, objective look. Whenever we see a number like that, the immediate analytical question we have to ask is, well, is this just a temporary post-pandemic anomaly, or is there a genuine structural shift happening within the company's operations that can actually sustain this momentum? That's exactly the puzzle we're solving today. To figure that out, here is our inspection checklist for today. 1. The business and the industry. 2. Drivers fueling explosive growth. 3. Financial strengths and valuation. 4. Key roadblocks and risks. 5. Bull versus bear case. And finally, 6. The final investment verdict. Starting with Section 1, the business and the industry, admiring the exterior. Now, understanding their exact role in the supply chain is absolutely crucial. Despite the name, BusCap doesn't actually build the mechanical chassis or the powertrain. Instead, they design and manufacture the specialized, highly customized bus bodies, and then they assemble them onto platforms sourced from major global brands like Scania, Volvo, Hino, and Yutong. They're the ones installing all the custom fittings and advanced safety features. So think of them essentially as the master tailors of the heavy vehicle world. They're crafting the completely built-up bus that you eventually step onto. And why does this specific niche matter so much? Well, you simply can't have a functioning, growing economy without a solid mobility backbone. With tourist arrivals in Malaysia normalizing and projected to hit 26.61 million in 2025, there is a massive underlying need for both public and private mobility. Excursion tours alone saw expenditures climb to over 4 billion ringgit in 2024. All of those people need to be moved efficiently, safely, and comfortably. And that creates a highly robust baseline demand for BusCap's products. Section 2, drivers fueling explosive growth, inspecting the engine. So here is a crucial point, and it's arguably the most important structural advantage BusCap has. This industry operates on a strict regulatory clock. Government guidelines mandate that stage buses absolutely must be replaced after 15 years, and express buses after just 10. Over in Singapore, it's 17 to 20 years. Operators legally cannot renew their licenses if their fleets exceed these limits. This creates a naturally recurring replacement cycle where operators are legally forced to buy new fleets, ensuring a steady stream of demand that's somewhat insulated from standard economic cycles. But wait, here is the absolute aha moment for their future growth. We like to call this the Trojan horse catalyst. Singapore is currently offering a massive heavy vehicle zero emissions grant of 40,000 Singapore dollars per electric bus, and they are tightening diesel emission standards aggressively by 2026. What does this mean? It means cross-border and local operators are scrambling to buy new EV chassis to get those grants and stay compliant. And remember what we said earlier? BusCap doesn't need to invent the EV battery. They just need to build the custom bodies that sit on top of the EV chassis from brands like Yutong. They literally get to surf this massive EV wave without taking on an ounce of the R&D risk of building the battery itself. To actually capture this wave, BusCap is executing a very specific internal strategy. They're using 57.3% of their IPO proceeds to pivot from a highly manual labor model over to automation. They're building a brand new factory right next to their current premises and installing semi-automated robotic welding machinery. This directly tackles their current production bottlenecks, and they estimate it'll increase their annual capacity by 15%, bringing them from 168 to 194 buses a year. This is the blueprint for how they plan to scale. Section 3, financial strengths and valuation. Checking the dashboard. Look at this incredible trajectory right here. The climb is just massive, from only 15.6 million ringgit in 2022, rocketing all the way up to 88.1 million ringgit by the end of 2025. And what's equally impressive is that their profit after tax grew from a mere 427,000 ringgit to a whopping 9.8 million ringgit, pushing their profit margins up to a very healthy 11.13%. On top of that, they've been cleaning up their balance sheet, dropping their gearing ratio down to just 0.28 times. So from a purely historical numbers perspective, the execution here has been incredibly strong. Which brings us to the valuation.
At an IPO price of 23 cents, they are entering the market at an 8.98 times price to earnings multiple. Now, in the context of a company experiencing triple-digit revenue bumps in recent years, a sub-9 PE ratio begs a really tough analytical question. Is this a fundamentally cheap valuation, or is the market already pricing in the fact that this hypergrowth is inevitably going to cool down, reflecting some underlying vulnerabilities?
Section 4, Key Roadblocks and Risks. Potholes on the horizon. Because to answer that valuation question, we really must slow down. No investment is without potholes, and you have to weigh their historical success against these brutal margin killers. First, the business is incredibly labor-intensive. Over 62.5% of their workforce is foreign manual labor. With the minimum wage in Malaysia just jumping from RM 1,500 to RM 1,700, that is a direct and permanent hit to their cost structure. Second, they have extreme exposure to global steel and aluminum prices. If geopolitical tensions spike shipping costs, their margins get squeezed hard. And third, they operate entirely on a per-purchase order basis. They have zero long-term recurring contracts, meaning revenue visibility from year to year is, well, about as clear as driving through heavy fog. And the absolute biggest danger of not having those long-term contracts is work in progress, or WIP risk. Building a bus takes time and heavy upfront capital. If a customer suddenly cancels an order halfway through production, which by the way is an incredibly painful reality in this industry, BusCap is left holding a partially finished bus. Their cash is literally trapped on the factory floor until they can manage to find a new buyer. This exact dynamic is why we saw their inventory levels surge to over 30 million ringgit recently. Managing this working capital bottleneck is absolutely critical for their survival. Section 5, Bull versus Bear Case, Taking It for a Test Drive. Let's distill all this data into a straightforward showdown. On one hand, the bull case assumes flawless execution of their new robotic factory. If they can use those IPO funds to successfully automate, they're going to slash labor costs, increase output to 194 buses, and perfectly capture that massive grant-funded EV replacement cycle over in Singapore. But on the other hand, the bear case points out that they face immediate, uncontrollable macroeconomic squeezes. If material costs spike, or if those rising wages completely outpace their automation efforts, combined with cyclical drops in orders because they have no locked-in contracts, well, those 11% profit margins could evaporate very, very quickly.
Section 6, Final Investment Verdict, the drop the mic conclusion.
Okay, bringing this explainer home. We've looked under the hood, checked the numbers, and weighed the risks. Here is the reality. BoostCap's recent explosive 78% growth was heavily accelerated by a post-COVID travel rebound. That specific hypergrowth rate is likely going to moderate. Moving forward, the company is transitioning from a recovery play into an automated efficiency play. Its future success and its ability to justify that 8.90 PE multiple rests entirely on whether that new robotic factory can be commissioned on time to outpace rising labor and material costs while simultaneously capturing the Singapore EV market. It's a solid business with a fascinating transition plan, leaving us with one final question for you to consider. Based on these structural shifts we've mapped out today, are you buying a ticket for this ride?